Good afternoon, everyone. Welcome to the November MSMF Wealth Management Podcast. I'm joined today, as always, by Jay Peters.
What's up?
And Cody Redding. Gentlemen, how are you?
Doing good?
Great. Yeah,
I know. MIZ.
ZOU.
big win.
All right. Boys behind the board are in it. Big victory. Big spank down in Tennessee. Man, that was fun. I was in attendance. So that's all I'll say. Hopefully there's no pictures. Okay, today we are getting to, gentlemen, the end of the year. And as you guys know, particularly here in kind of what I'll call the backstage, so that the clients don't really see, there's a lot going on. All right, we're checking in on a lot of different things on clients' behalf, getting a lot of clients on the phone, doing all sorts of things that we're going to talk about today just to make sure we meet IRS deadlines, all these other happy things. So today, I'm going to call it the Magnificent Seven of year-end planning or strategy. So we're going to walk through this checklist of the Magnificent Seven. I'm going to have you guys explain for our clients what they need to be looking at. We're kind of organized. There's a handful that are as much tax planning as anything. There are a handful that are really strategy and planning. Mm-hmm. And then there's one that's really, Jay, looking at it next year that we'll talk about. Mm-hmm. Okay. The one thing I will say as a disclaimer to keep my good friends in compliance happy, we are not CPAs, right? We know a lot about taxes and what goes on tax returns, but we don't prepare returns. We're not CPAs. So if you have a question on this, feel free to call us and we'll get you or send you over to talk to your tax professional to confirm some of this. I'll also say this is not an exhaustive list. There are more things that we consider towards year end. And there's also a lot more details on the Magnificent Seven that we won't get to today. It would take probably a 3-hour podcast to cover everything. Yeah. But as always, if this comes up, you got any questions, please reach out. We'll talk a little bit more about that later. So let's kick it off. Cody, I'm going to start with you. One of the most common year-end items, and really is the top of anyone's list, particularly the Magnificent Seven, is what we call required minimum distributions, or RMDs. So give us some coaching and thoughts around that.
Yeah, so required minimum distributions. So those are basically withdrawals you have to take out of your IRA or qualified account. There's a chart the government provides, and you got to take them out a distribution each year by 12/31. So you certainly don't want to be late on that because it is the most heinous tax penalty there is.
They have lowered it.
That is changing because of Secure 2.0. I think it went down to 25%.
25,
maybe?
And you can get it all the way down to 10.
Ooh, yeah. So it used to be 50.
5-0. Pretty heinous.
So you don't want to miss taking it out because, of course, yes, the government wants you to pay taxes on the withdrawal. A couple of things that did change was Secure 2.0 that was passed in the wee hours on 12/31, I believe, of last year.
It was signed into law by the president when he was in the Caribbean, as a matter of fact.
Funny how that works. But so basically anyone who turns 72 this year can take their RMD now at age 73. And anyone born before 1960 has to take it by age 73. So if you remember, before Secure Act was even around, it was 70 and a half. Then it Secure 1.0 changed to 72. Mm-hmm. Now it's 73. And if you're born in 1960 or later, it's going to be age 75. So not to make anything confusing at all, but those are the new rules.
Hey, by the way, that does include me. You guys are probably thinking I was the earlier age. I'm 75 now.
No comment.
And if you took one last year, just know that you're going to be due to take one this year by the end of the year. And there are no RMDs for Roth IRA owners, so traditional assets, unless it's inherited. Anyone who has inherited money of any sorts has to start taking some RMDs. Mm-hmm. And there is RMDs if you're in the 1.0 and after. So if you started taking RMDs after 2020, I believe.
2020.
20 and beyond. You have to take it out in a 10-year period, meaning the IRA account has to be zero balance at the end of the 10th year.
Inherited. Right.
Inherited, correct.
Right.
there is, because of confusion on that, yes, even though you have to have it by 0 at the end of the 10th year, you still have to take RMDs through each of those years. But IRS went back and waived it for 2022 and 2023 because of all the confusion. But for most of our clients, we're telling them to go ahead and take it just because tax planning purposes on that end.
Right.
Yeah. So that the RMDs, it's rather confusing, but we have it for all of you guys and we keep track of it.
Right.
Yeah.
Yeah. Inheritors are really kind of confusing. Again, inherited before 2020, you have a different set of rules than if you inherited after 2020.
Yes.
And if you inherited after 2020, you have a different set of rules depending on whether the person you inherited from was taking RMDs or not taking RMDs.
Yep.
Or if they're your spouse or not.
Correct.
Yeah.
And that could take us a healthy 45 minutes. So if you have an inherited IRA, we have these rules posted all over the office, and these guys are great with them. Please call us because it can be kind of dicey, but we'll talk you through it. And I think if people are under the 10-year rule and they're taking out a little bit, I think you're right, Cody. Tax rates are going up in January of 2026, so it may be advisable to take it anyway. So we can talk through all that. Okay, RMDs, to kick us off on the Magnificent Seven, let's move on to what we feel, I think, is an important planning topic, which a lot of our clients use, something called Qualified Charitable Distributions, or QCDs.
Yeah.
And I'm going right back to you.
Yeah, I think, important in a couple of ways is it allows you, and they kept the old RMD age of 70 and a half, so you can do this before technically RMD, but you have to be 70 and a half or older to initiate it.
To make it even more confusing.
To even make it more confusing. Yep. So you can do up to $100,000 distribution out of your IRA to a charity of your choice. The check has to be made out directly to the charity, but you don't pay taxes on that. So especially in the world of where the tax code change and the standard deduction is quite large, especially for married couples, to get above that amount, to be able to make charitable contributions, you can now do it out of your IRA and not have to pay any taxes on it. Right. So you're able to do the same thing. So we do have a lot of clients that utilize that. And I think one rule change with it this year was with the Secure Act 2.0 is that now it's subject to inflation. Right. So that number will go up throughout the course of the year, and I guess until 2026, and they change it all again.
And then who knows?
Yeah. And you can use that to help satisfy your RMDs as well. So if you have to have an RMD of $150,000, you can take $100 of that, send it to a charity, and not have to pay taxes on it.
That would be quite an IRA.
That would be an IRA.
To have a $150,000 RMD. Yeah. Kudos to that client.
Absolutely. And some people also do it to mitigate these stealth taxes, what Mark's like to say.
Stealthy. The government is stealthy.
Based on your AGI and the kind of bypass that 3.8% tax that you have on that investment Medicare surcharge.
Yep.
So certainly some tax strategy practices that go along with that.
Yeah, and it's I guess I'm glad they didn't adjust the age, but it does make it a little more confusing. I think the most we see it is clients who don't need their RMDs from an income perspective, or maybe not all of it, and then will and you can split it between multiple charities. But to your point, the key thing is it's actually directly sent to the charity from the IRA, from the company, the custodian.
Yes.
It does not come into our client's checkbook or savings account first. If you've done that, now you've made a taxable distribution. The custodian, a Schwab, a Vanguard, a Fidelity, a Pershing, they send the money directly. Mm-hmm. Yeah, cool. All right, let's keep rolling, Mr. Tax Guy, even though you're not a CPA.
That's correct.
That's just a joke, Mr. Tax Guy. The compliance. All right. Next one is one that we use routinely, regardless of kind of what's going on, and that's tax loss harvesting. Why don't you tell us a little bit about what that is and what it can do for us?
Yeah. So especially last year with the not good market year that we had, but it allows you to take a look at your individual holdings that you have, and if you have some poor performing investments in there, you can actually harvest that tax, mean take the loss on it, and you can help offset all your gains that you have for that year. Or if you don't have any gains to offset it with, you're allowed to take $3,000 against your earned income. And that is, it doesn't matter if you're a single filer or joint file, it's per tax return that $3,000 is. But it's a way to, again, help out. There's some tax strategies involved with that. And again, last year we utilized that a lot with clients that had large losses because of the down year in the market. Hopefully this year there's a little less of that to utilize.
Absolutely. Yeah, and it's something I know that you guys do. The team helps you run what we call an unrealized gain loss report. And we can see all the clients and then call and talk to them about the advisability of thinking about that, talk to their tax professional. There's a threshold which kind of makes sense, doesn't make sense to go through the exercise. But yeah, it's something that's important, something that we kind of look at in the backstage and then bring up to the clients if it seems like it's appropriate.
Yes.
All good strategies. Man, that's a lot of tax talk. Jay, let's how about we convert over to some planning or strategy conversation.
All right.
The first one is one I know you guys talk about all the time with clients. I know that Craig and I have been talking to clients nonstop about this, particularly in light of what we just mentioned on the distributions, required distributions, the at least current change in the tax code on January 1st, 2026. Jay, talk to us about Roth conversions.
Sure. And Roth conversions are really good for lowering that. You mentioned the large RMD possibility. I actually was looking at a client last week where that was a reality.
Right.
And so we're like, what if we do some Roth conversions now, right? So what is a Roth conversion? That is, there's two kind of flavors of retirement accounts. One would be you've taken a tax deduction, so you've never paid taxes on that money. And on the other side, the Roth, you kind of prepay the taxes at today's rates, and then it gets to grow tax-free, right? And so what you're doing is you're converting it from traditional paying the taxes on it, take it as income, and then put it immediately into your Roth IRA. Usually it just goes straight to it, right? So that then you get the tax-free growth on it. The benefit, Cody already said, when you do RMDs, you don't have to take anything from a Roth IRA.
Right.
So that lowers that. And you also get the advantage of it's growing tax-free. So the younger you are, the more it usually makes sense. And it's also kind of playing the tax bracket game. Am I going to be in a higher tax bracket now, where I should probably put it in a traditional, or should I convert it now because I think I'm going to pay higher taxes later? So that's something we look at every single year. Does it make sense to do that or not? But because in the long run, you're trying to lower how much you're paying in taxes over the long run. Not today, not tomorrow, over the whole thing.
Right.
And sometimes across generations too. So maybe you're trying to, because when it passes to your kids, a Roth IRA or whomever your beneficiary is, a Roth IRA is not taxable again.
Right.
So again, it's trying to control tax liability over time, not just today.
Excellent. So in essence, you're cashing out the IRA or IRS today.
Yes.
Right.
Yeah, they're saying, I'm done. I know what the liability is. I'm done.
Right. And I think one of the cool benefits is if you think the year or two or three after, to your point, now you're lowering the required distributions on the traditional IRA. So there's a multi-year potential benefit in this in terms of cashing out our buddies at the IRS.
And I thought of something else as you're saying that. When you talk about retirement income planning too, now you have another bucket of income to think about that you don't have to worry about taxes on too.
Right.
So there's more than one reason to really consider a conversion.
Right. Absolutely. Not least switches January 1st, 2026. Have I mentioned that yet? That tax rates are projected to change. All right. Great stuff, Jay. I'm going to stick with you. And I know we talk about this all the time. We have a pet name for HSAs, which I'll let you get into. But, a health savings account and flexible spending accounts, for different reasons, they're a pretty big deal to look at year end. Why don't you walk us through that?
So a couple things to think about. We're kind of in benefits election season. So usually October, November, you're setting up next year of what your benefit elections are, with your employer. So a couple things to think about. With an FSA, remember you need to make sure you've spent it down if you have anything left, right?
Use it or lose it.
It doesn't roll over. So that's kind of a reminder, hey, what's that account balance look like?
Sure.
Now, the nice part is HSAs, that's not the point, or that's not the same thing. You get to carry that over. It's portable. You can take it with you. So that's why we like HSAs. Now, each one has their benefit and their reasons and their uses. So a quick thing on that, I'm just meeting with someone yesterday. They compared their different benefit options between the regular plan and the high deductible plan where they can add an HSA. And it was like $1 different a pay period. And so we did the math. We're like, okay, it makes sense. Now we get to also contribute to an HSA. Why do we love HSAs? They are triple tax advantaged. Triple taxed, right? So one, you get to deduct it from your income this year. It grows tax-free. And as long as you use anything in the account for a qualified medical expense, you never pay taxes on it. It's 100% tax-free. One of the few times you ever get to do that or say that.
Few. Might be the only. Which is why we call it a unicorn.
Oh, okay.
It's the unicorn of the U.S. tax code. It's HSAs.
HSAs. So when we're talking about that, so make sure you're using, your FSAs, taking a look at, well, what's this year look like? What does next year kind of look like? Should we maybe make a difference there? And understand the difference between the two. The other thing I didn't even talk about is there's dependent care FSAs too. So there's just all kinds of nuance to that. But taking a look at your options and knowing what you can do with it.
Yeah, and the one thing I would add to that, and you kind of mentioned, I want to hit it again. You may not have both of these available. It depends on the type of health insurance coverage that you're offered at your employer.
Right.
HSAs are strictly tied to high deductible plans, like $5,000 deductible, right? And if that type of plan is not offered, then you may have an FSA, or sadly, you may not have either one, depending on the employer, right? Excuse me. And I would say these guys deal with this all the time, and then kind of coach clients on what they should consider. So if you have a question, please do not hesitate to call and ask them. Quickly on this, Jay, any other benefit elections you suggest people pay attention to here at year end?
It's a good time to review, obviously health, vision, and dental, right? But also if they offer some sort of legal services, if they offer some sort of estate planning stuff, credit repair, those types of benefits.
Identity theft is a big one.
Yeah. And also just what are the retirement benefits as well? What are you contributing to your retirement account? Should you be? Do they offer a match? All those different kind of fun questions.
Gotcha. Super. Let's keep rolling on some strategy items, Jay. And I want to talk about annual gifts. And I just want to tell you guys, I volunteer to be a recipient of your gifting plan. So if we want to get that down, figured out today, that'd be great.
Sounds good. You are in line. I just won't tell you what number you are.
742. Go ahead.
Yeah. So what we're talking about is every year you can gift someone else on a different tax return. If you think about it that way, you can give them some money up to a certain point, and you don't have to worry about paying gift taxes. This is what we're talking about. For this year, it's $17,000 per person, $34,000 per couple. So if you think about that, you can give some serious money to somebody. So we're talking with a lot of people who, especially if they're already retired and they're looking at their assets and saying, I'm never going to spend all this. What do I do with it? That's when we're bringing up, okay, well, should we look at maybe gifting some of this? And then you can maybe see the person you give it to be able to use it. And so that's really a positive thing that we're talking about with gifting strategies.
Absolutely.
There is a gift exemption, so there's a limit that they'll do it. There's not only the year by year, but there's also a total thing, and that changes also at the same time as the tax code. Right?
January 1st, 2026, if I haven't already mentioned
We'll
that.
just keep saying it. In which case, it's pretty high right now. It's $12,920,000 per person, but we think it's probably going to change in not too long. So keep an eye on that. And then one other quick reminder for donor advised funds. So that's where you get to kind of get the advantage of giving it to a charity or something now and take that deduction.
Right.
But you get to kind of control it, do what you want with it, and then eventually it goes on to that charity. There is a deadline of 12/31 to do that for this tax year too.
Right.
So I want to mention that for sure.
Absolutely. So our friends at the IRS, they tax us when we earn it. They tax us when we give it away, potentially when we're alive, and they try to tax us when we die and give it away. Now, the limits are really attractive right now. January 1st, 2026, they get a lot less attractive. So if you got any questions on any of this, please call and ask, okay? Lastly, Jay, let's kick us off into 2024. What should people be thinking about?
So we've been making an effort to really talk more about goals. And so I just want to take a minute and talk about your goals too, right? So the first thing I would recommend is think about this year. What happened? What went well? What maybe didn't go so well? What lessons can we learn from the year, right? And so then that way we can kind of check off or make a mental note of, I think I want to take care of blank, or I want to increase blank, or whatever for the next year. So that's the first thing. The second thing is think about what's going to happen next year. Maybe there is a milestone or an event that's coming up that we need to make sure we have a plan for. So whether it's saving for said event or just a liquidation strategy for that event or an income strategy, there's all kinds of things that I don't want to go through a list, but what's happening next year that we can maybe be starting steps today.
Super.
And then the third thing would be, is it maybe time to increase our savings for next year? So a lot of times when we talk about setting a savings target, we'll do a percentage of income.
Sure.
And then we'll say, okay, we're going to start at X, and then next year we're going to do X plus 1. And then next year X plus another 1, so that we're always increasing how much we're saving and staying within our means. So now's the time to be thinking about, is it time to be increasing that for next year? And then the last thing is, our goal is to sit down and make a financial blueprint for everybody. I feel like everybody needs that, right? Super important. And when we're talking about that, there are maybe things that we addressed at the beginning of the year that maybe we didn't get to all the way across the finish line.
Sure.
Or we just set aside, we're going to figure that out later, right? So make sure that those get added to the 2024 goals list too. We want to do these different things.
Super. Great stuff. Final words of wisdom?
MIZ.
M-I-Z. Z-O-U, my brother.
Cheers back there.
Cody, final words of wisdom, sir.
I think with the RMDs and all the new rule changes, there are certainly some good planning techniques that you can address and really help out the tax situation, since you have to disperse that IRA in that 10-year period. That's where it's really beneficial to talk to, financial professional and have them guide you through that strategy. Right. And number one, to make sure you don't make a mistake, because that's usually the biggest flaw, especially if you get your tax return, audited or whatever it might be, that you made a mistake on the RMDs.
Right. Yeah, and I think it's great advice, and you guys know this. Secure 2.0, my opinion, was one of the most poorly written pieces of legislation that we've seen in a long time. And the IRS has a lot of cleanup work to do on that piece of legislation, and there's no telling when we're going to get it. So, as I mentioned, this is just at the beginning of the podcast. We're just touching on all these things. There's a lot more details surrounding all of them. So I would urge everyone, please do not hesitate to call and talk to us. Again, we'll make sure that between you and us, and if you have a tax professional, we do our damnedest to avoid any of those mistakes, because there's some potholes out there. In some cases, there's some landmines, but these are 7 legit, magnificent strategies to consider before the end of the year. Please call, email, use the text line, call these guys, call me, call Craig, call anyone on the team, and certainly we'll help you walk through this and take advantage of what some of these opportunities are. Because the one thing we know, and we already know it's on the books, barring other changes, it's always going to change. We're always going to get changes on all these things that we have to manage to. So, just think of the checklist, ask the questions, and we'll get you on the straight and narrow. So happy holidays to everybody. Probably not going to do a podcast in December, so we'll see you in January. Gentlemen, appreciate your help as always. Great expertise, and MIZ. See you guys later.